Hey everybody, welcome to our talk today. As a brief introduction, my name is Jeff Rudner. I'm the co-founder and COO of Proseer. We are a modern accounting firm bringing a combination of people, process, and technology to entrepreneurs looking to scale their businesses. With me today is my co-founder and CEO of Proseer, Larry Bernstein. Larry, you want to introduce yourself?
Hey everybody, Larry Bernstein, and as Jeff mentioned, I'm the CEO and the co-founder here at Proseer.
Awesome. Today, Larry's here because we are talking through the top 5 tax compliance tips for entrepreneurs. Larry, why is this an important topic and why should entrepreneurs care?
Tax structuring and tax planning have a really significant impact on the ultimate amount of tax you pay, on the hard work that you put in for your business. And for some businesses, taxes can be 30, 40, sometimes even 50% net income or profit. And so appropriate planning can make sure you're still within the law, but paying only the amount that you're legally required to pay.
Awesome. And we do a lot of this work with our clients. We're very hands-on, looking at all of our clients' details. And so today we're going to go over some tips of things that every business owner, regardless of whether you're a client of ours or not, should know and should consider and to talk with their accountant about. So let's kick it off. The first thing that we recommend that all business owners know and focus on is choosing the right tax structure. Larry, what are the different types of tax structures and what are some of the pros and cons of each?
So, when you think about tax structures, what this means is how is your business going to file taxes and how is it structured legally at a state level? So you have no structure. That's a sole proprietorship. That just means that one person owns the business. There's not an LLC or a corporation, and that just gets taxed on your individual tax return. It's the simplest way to do it. This is good for kind of like hobbyists and people who have maybe a small side hustle, something like this. That's a sole proprietorship generally. If you're running a real business as a sole proprietorship that's making significant income, tax planning and structuring is very important. The next kind is going to be a pass-through entity, and there's a couple different types of pass-through entities. The most common are partnerships and S-corps. Now, a partnership is generally going to be an LLC with multiple members, but it could also be other types of state legal entities, like an LLP, an LP, something like this can be a partnership. And a partnership is great because you have the most flexibility through your operating agreement or your partnership agreement about how the money will be distributed out to partners and how income or loss will be allocated to partners. Pretty much, if you can dream it and it has economic effect, you, your lawyer, and your accountant can make that happen. The next version of a pass-through entity is an S-corp. And you hear a lot of people talk about S-corps. We like S-corps, but only for certain types of businesses. S-corps aren't great for every business type. But the reason that S-corps are good is because you can limit your exposure to self-employment tax by only paying self-employment tax on what's deemed a reasonable salary. So an S-corp is a very popular strategy, but it's also not the right type of entity to hold certain things. So for example, if you have real estate in an S-corp, that's probably not a great structure, okay? But if you're running a professional services business in an S-corp, that might work, but there are reasons that it still may not be the best. So every situation is different. The last kind is a corporation. And when I say last, I don't mean this is an all-encompassing discussion. The last most common type is a corporation. S corporation has the word corporation in it, true. But what we're talking about when we say corporation, that's a C corporation. C corporation is its own taxpayer. The other ones are all going to be taxed at the individual level. But a C corp, as its own taxpayer, will pay corporate tax, which has a flat rate of 21% federally, state tax potentially, and all of them actually could have state tax implications, but it'll pay its own state tax. And then if there's money that's going to get distributed out to the owners of the business, it's possible that will be taxed as a dividend, so a second layer of tax. So a corporation can be one of the more expensive ways for tax to be structured, but not always. It kind of depends on, again, what your cash flow looks like and your plans for the business.
Awesome. Thanks for the overview. Definitely super important to talk to an expert to discuss your facts and circumstances so that we optimize the tax structure because, as Larry mentioned, there's so many different nuances that can come into play. We hear a lot about the S-corp. A lot of different firms advertise S-corp, 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 but that's a great point Larry made that it doesn't work for every business and it's not the ideal. So make sure you know what you're getting yourself into. You do that by working with a professional to do that. So awesome. Thanks, Larry. Let's move on to our second tip. Keep accurate and organized records. Larry, why is it important to keep accurate and organized records, and how can the average business owner get this done easily?
So there are many reasons why having organized accounting records are helpful. For one, it'll help you run your business better, right? Instead of running based on gut feel, you'll know, how are we doing this quarter? How do we do this quarter versus last year this quarter, or versus the prior quarter? What do our trends look like? But from a tax perspective, it's important to have accurate financials for a couple of reasons. Reason number one is you want to make sure that certain expenses are booked as business expenses into your books, right? And for things that are tax sensitive, that they're recorded as such. What are tax sensitive types of accounts? A lot of them are things that are not deductible. So meals sometimes will have a limited deduction. Entertainment, which is often combined. You'll see people put meals and entertainment into one account. That's not a good idea, because entertainment is fully not deductible, whereas meals are still 50% deductible. And in prior recent years, or post-COVID, they've been 100% deductible. So keeping this stuff organized is really important.
Yep, absolutely. I'm going to hold you off there a little bit on the deductibility. You're jumping ahead. We're gonna get into deductibility in just a second here, but obviously it's super important to make sure.
Let's roll back then. We'll have that expire.
Nah, no worries. Let's go back to just general record keeping. Obviously, it's so important for the business to know how they're doing, but also when it comes time to prepare taxes, having accurate books is going to make sure your tax preparer can prepare your returns in a timely manner, as opposed to having to do the books from scratch in time for filing. What are some ways that you can keep your books and records up to date in a timely manner, Larry?
There are a number of ways to keep your books up to date, and some of them are driven by people, process, and technology, right? Set up an accounting system. At the most basic level, that could be Excel for some sort of small business, or just making sure you have separate bank accounts and credit cards that are exclusively used for business, and then summarizing them. I feel like the most basic way to do it.
Yep.
But as businesses become more sophisticated and have more transaction volume and more reporting needs, then it makes sense to invest in accounting software and potentially a team of accountants who can help keep that up and keep it current. And so when you go into accounting software, now it's, well, which software should we use, and what's the pros and cons of doing these things? And then how do we configure it all? Now, a lot of times consumer accounting technology like QuickBooks, which we like, by the way, makes it seem like it'd be very easy for anybody to set up. But the reality is, we've seen many, many times when people try to set up their own QuickBooks, they're shooting themselves in the foot, because the choices they make at the beginning have knock-on effects. And maybe those choices they made weren't as best choices that they could have made for their business. So once you have your accounting system set up, you connect your bank accounts and credit cards via username and password. So bank feeds are set up, which makes transactions flow into the system. Next, your job is to categorize those things inside of the system to the appropriate general ledger accounts. After that, you want to think about integrating accounts payable and receivable. This is money that customers owe you, or money that you owe to your vendors, right? Making sure all that kind of stuff works together smoothly and together. If you have employees with expenses that need to be reimbursed, setting up an employee expense reimbursement policy. So that's about process, right? But then technology to actually execute it with approvals and things like that can be quite helpful. Within that, we talked about accountable plans, and accountable plans will just make it so those expenses are not included in those employees' income, and instead they are just full reimbursements, which is an important point.
Awesome. So there's definitely a lot of layers in just how advanced you want to get with your books. If you're just trying to get your taxes done, as Larry mentioned, an Excel spreadsheet should be able to work if you're able to keep it up. But for those businesses that really want to run their business based on data, there's a lot more ways that you can plug in the best in breed apps to give you full visibility into your business and make sure your books are kept up to date so you can make those decisions. Awesome. Thanks, Larry. So let's move on to number 3. We touched on it a little bit before, but you need to understand the difference between deductible and non-deductible expenses. So Larry, you mentioned it briefly, but what are deductible expenses, and why is it necessary to differentiate in your accounting between deductible and non-deductible?
Well, first of all, getting the most deductions possible will reduce your taxable income. A reduced or lower taxable income generally means less tax, less tax, less money out the door. It's a good thing. However, we only want to deduct things that we're legally allowed to deduct so that we don't potentially get in trouble with the government. So it's important to know what is deductible and sometimes what kind of special deductions are available, right? So we have things like bonus depreciation. We have credits for research and development. We have credits for energy. There's all sorts of things that we want to understand deductibility and credits on. Now, by maintaining an accurate accounting system and working with a good advisor, we can maximize opportunities here and potentially even recommend incurring additional expenses or costs that can generate those deductions if you are already going to spend that money anyway. Make sure you can get the best deduction possible. It's always important not to let the tax tail wag the dog, as they say.
Yep.
Because yes, maybe you get a deduction, but that still costs cash. So you still only want to spend the money if it makes sense to spend the money to help your business.
That's right. Yeah, we get that question a lot. Our clients come to us and say, I'm going to buy this because it's a tax write-off. And, if your tax rate is 30%, for every dollar you're spending, you're still out 70 cents of cash to save that money. So definitely recommend having a business sense. You need to have a business case for everything, but make sure you're only incurring things that are right for the business and are helping you achieve your overall goals. Don't let the tax tail wag the dog, as Larry said.
There you go. You got
awesome. It. Nice. All right, cool. We know that many business owners get tripped up between personal and business expenses. So it's super, super important to get that right throughout the year and before you file. So our next tip, talking about getting into the filing and payments theme, is plan for quarterly estimated tax payments. So Larry, what is the requirement for quarterly estimated tax payments, and how should business owners approach the requirement?
So these requirements are a little bit different for corporations and individuals. So we're going to talk about individuals, which is the most common, okay? Individuals are also going to be the taxpayer for all the pass-through entities we talked about, whether it's an S Corp or a partnership. So this is where those are going to come in. But generally, and like everything in tax, there's exceptions, but generally, you need to pay in every quarter an amount so that at the end of all 4 quarters, you've paid in at least 110% of last year's tax for high earners, or that's in a year of increasing income, or in a year of decreasing income, at least 90% of the current year's amount. Now, I say you need to. Well, in tax, there's really never a need to. What's the cost of not complying? The cost of not complying is interest. Non-deductible interest at that. And so it's important to understand what is the cost of not making these payments so that you can make an educated decision about how much to pay in and at what point will you be in what's called the safe harbor and not be subject to those interest and penalties.
Awesome. And just because you mentioned it for the first time, safe harbor, that was the different payment rates that you mentioned previously. Can you just go over that again? What is safe harbor?
So a safe harbor with the IRS with regard to estimated tax payments is, if you make at least this much in payments, you get to the safe harbor amount, then you will not be subject to underpayment interest penalties. Okay? And again, in a year of increasing income, you want to hit 110% of prior year tax. In a year of decreasing income, at least 90% of current year tax. You hit either one of those, spread out across the 4 quarters, and you've met the safe harbor. Then come April of next year, you'll need to make sure that you paid in the full amount of tax due, or an estimate of the full amount of tax due.
Got it. And so the safe harbor just comes into play because if you hit the safe harbor, if you meet safe harbor requirements, you don't incur penalties and interest. Is that right?
Yeah, the underpayment interest, which is non-deductible. Yep.
Awesome. Cool. And so what do you recommend in terms of calculating? If you're not going to safe harbor, it can be pretty complicated to calculate this on your own, right? It's probably something you should work with a professional on.
Yeah, the easy one obviously is a year of increasing income, 110% of last year's tax. If you hit that, you know you're safe harbored. It's based on a number from last year, which you already know generally, and you're good to go. In a year of decreasing income, it's challenging because how do you know how much 90% of the current year's tax is going to be? Well, it's a guess. Yeah. And the only way you can do that is based on accurate books and records, like we talked about earlier.
Yep. And a forecast even.
Sure. Yep.
Awesome. Let's move to our 5th tip. So we spent a lot of time today talking about income tax requirements, but there are other types of tax, whether that's excise tax, local taxes. So that brings us to our 5th important tip for business owners, consider whether you have a requirement to collect and remit sales tax. So we're going to focus on sales tax here. Obviously, there's other types of taxes, but regarding sales tax, Larry, this is a big topic. Can you summarize it for us? And what are some things that business owners need to consider when it comes to sales tax?
Yep. And just like we talked about before with regard to federal estimated taxes, every state's also going to have state income taxes, which you may or may not be subject to. Now, talking about sales tax in a day before the internet was relatively easy. Wherever you had a store or location, you collected sales tax based on where you physically were, right? So a lot of our work is in Broward County, Fort Lauderdale, Florida. And in Broward County, you have a 6% state sales tax, and a 1% county sales tax. Together, that's 7%. And that gets remitted to the state, usually every month. And that's based on work for products that are sold here in Broward County. But what happens when you have an operation that's operating in multiple jurisdictions, multiple cities, counties, etc.? Well, if you're operating across the state of Florida, you may be subject to rates in every county, and those rates are often different. We have a 6% flat state rate, but every county can be a little bit different. Maybe they have 1% in Dade, but in other counties, maybe it's 1.5% or 0 or any other number, right? So it's important to understand how that works. And then as you expand outside of Florida, there's 49 more states, and every one of those states also has their own local sales tax jurisdictions, some at the county level, some at the city level. And altogether throughout the country, there's something like 22,000 separate sales tax jurisdictions. And so where this really comes into play for what we see as small businesses is e-commerce sellers. So if you're operating an e-commerce company and you're selling into, let's say, New York and California and Illinois and all these other states, Georgia, the only way to really handle this when you're selling significant volume into these states is to use software. But that software needs to be configured, and what's called a nexus analysis needs to be done. And so first we start with, where do we have nexus? And in e-commerce, nexus is going to be, where do we have employees? Where do we have inventory and warehouses? And if we don't have any of those in the state, then do we have a significant amount of sales, which creates what's called economic nexus rather than physical nexus? And if either one of those things are triggered, we need to collect and remit in those states, right? Once we decide we need to collect and remit, we got to configure the software to do that collection and remittance and register to collect and get a sales tax ID number in those states.
Got it. And you mentioned 20,000 jurisdictions. That's really 20,000 different rules that you have to consider, right? Potentially. And so, you mentioned this word nexus. Can you just talk a little bit about what that means, and for a small business owner, what they need to consider to determine whether or not they have nexus?
Yeah, so nexus is, I believe, a Latin word, but it means connection to. If you have a connection to or nexus to a particular state or jurisdiction, that jurisdiction has the right and the ability to impose tax on you, right? So if there's nexus, they can impose tax. The next part, though, is going to be figuring out, once we know we have either physical nexus or economic nexus, all right, then do we need to register to do business? Do we need to register for a sales tax ID number? And then once we do that, let's configure software to make sure first we collect the tax from our customers when they buy something, right? Because any dollar not collected is still a cost for the company they need to pay.
Right.
So it can either come off your profit or it can come from your customer. Mm-hmm. Might as well come from your customers. You're not going to lose the sale because you didn't collect sales tax, because you didn't charge sales tax. Customers will pay it. You should collect it.
Awesome. Yeah, sales tax, very, very complex and changed significantly in recent history. So definitely helps to work with a professional there to make sure you're covered, because we've seen states come after small businesses, and it's a lot of work to catch it up. So best to get it right from the beginning. Well, Larry,
it's not only a lot of work, it can also cost a lot of money. All those back taxes are going to be due. And they can also potentially have income tax consequences as well. It's unfortunately very complicated. And many entrepreneurs will tell us that, hey, this doesn't really make a lot of sense. And they're right. I mean, it's not a federal law, so every state's got their own thing they got to do. And that's just kind of the world we live in today.
Great way to sum it up. Awesome. Well, Larry, thanks a lot. That was very, very helpful. As a quick summary for everybody, here are the top 5 tax compliance tips that every small business owner needs to know. 1, choose the right business structure. 2, keep accurate and organized records. Number 3, understand deductible expenses. Number 4, plan for quarterly estimated tax payments. And then number 5, consider whether you have a requirement to collect and remit sales taxes. We are Proseer. We are a modern accounting firm supporting entrepreneur-led businesses looking to scale. If you have any interest in learning more about the topics we discussed today, reach out to us or stay tuned for more. Thanks.